Hey, thanks for watching. Coming to you from Fool Global Headquarters in Alexandria, Virginia. I'm Chris Hill, here with senior analyst Jason Moser and Ron Gross. Thanks for being here, guys.
It's a pleasure. A lot of fun.
This is an appropriate month for us to be talking about getting ready for a market crash. If you just think about history, it was October '87 we had the crash. On this day, 90 years ago, the kickoff of the Great Depression. So with that in mind,
A scary month in more ways than
let's
one.
face it, this is a fact of life. It's been an amazing 10-year run for the bull market, but it's going to end at some point, Ron. Let's talk about some of the things first that folks can do to get ready, sort of a checklist of where you want to be when the next crash comes.
I think there's certain things you can do that you should always do, and not just when you start to get nervous. And the things that I want to highlight are, first, you should have an emergency fund. The rule of thumb is 6 months of cash to cover your expenses, your fixed expenses. Variable, you can see less movies if you need to, but you still have to pay your rent. So 6 months, I know that's a big number. Let's at least strive for 3 months of expenses in the bank. Don't invest money in the stock market that you need in the next 3 years. Some people even say 5 years. You don't want to put money you're going to need at risk. And finally, you should always do this. Hold a diversified portfolio that's appropriate for your age, your status in life, your risk tolerance. So fine to own growth stocks, more than fine, but have it be appropriate to your risk tolerance and where you are in life.
Well, and to that point, Jason, one of the things that's always important to focus on as an investor is what your timeline is. You know, if you're a younger person, you're just starting out, you're looking at maybe 50 years of investing ahead of you. If you're at or near retirement age, your timeline's a little tighter.
Well, what if you're in the middle? You're in that twilight zone like I am, Chris. I'm not young, I'm not old, I'm kind of just in the middle there, and I'm not really exactly sure what to tell you. But let's look at it from the perspective of growing your wealth versus protecting your wealth. Like you're talking about there, younger investors, you're focused on growing your wealth, you can take more risk. Older investors, you're looking to protect your wealth more. That's going to really help dictate the portfolio that you set up. But I like the things that Ron was talking about here, because as much as we talk about investing and stock ideas and all of that stuff here, there are some ducks you need to have in a row before you even really look at the investing angle. When you think about the things that happen in a recession, I mean, a couple of things that stand out. Unemployment tends to go up in a recession, right? I mean, not everybody is necessarily going to have the same employment status. And right now, it seems like unemployment's about as low as it can go. But when a recession hits, that unemployment does go up. And with that, you also see employers cutting back on benefits. So doing a little bit of an audit maybe with your employer, understanding the benefits that you have, could be a really good first step in order to help you prepare as an investor for that recession that is coming at some point or another.
It is interesting to differentiate. Market crashes or corrections, bear markets, and recessions are not necessarily the same thing. In fact, they're not. But they often come right about at the same time, but not always.
It's a great point, and we're going to be taking your questions in just a moment. And Ron and Jason have a few recession-ready stocks, if you will, companies that tend to do well in recessions. Ron, let's go back to something we were talking about right before we started here today, and that is temperament. Temperament is always important as an investor, but it really seems like if we're dealing with any kind of a correction or certainly an economic recession, it becomes even more crucial.
Without a doubt. First thing is to don't panic. Second thing is, this is what I do. Don't look at your brokerage statement every single day. It's almost impossible for you to kind of equal out your temperament when you're feeding yourself with that data that can kind of be somewhat troubling. But if you realize that you have a long-term investment horizon and you realize you don't need that money over the next 3 years, then you can look at history as a guide, and you can see that yes, recessions happen periodically, but they last much shorter period of time than expansions. Yes, you can see that corrections and bear markets happen from time to time, but again, those expansions in the stock market last much, much longer than the correction periods do. And so you can actually look at history over the last 100 years as your guide to help you kind of remain calm.
It's interesting, Jason, because you think about Ron's point there of don't panic. And look, speaking of averages, we've had a bull market that's lasted much longer than average. And sometimes I feel like there are people who are in the professional panic business. They come out every 6 months and they're saying, no, a market crash is coming. Just buy my book and I'll tell you how to survive it. So that whole thing of not focusing on panicking, not looking at your brokerage statement every day, it gets a little bit tougher in times like these.
I mean, it does. And I mean, if you look at the actual data, I mean, the U.S., we've experienced a recession every decade since the 1850s. Now, we're getting ready to wrap up yet another decade. However, it looks like we may actually skate through this one without a recession. So then, of course, that panic media is going to be like, hey, wait a minute. Now, I mean, that's another sign that it's just on the horizon. Again, you have to take this sort of from the perspective that's, it's inevitable, it's going to happen. So then you look at it from that longer term approach. You prepare yourself accordingly. It's not like you have to adjust your behavior quarter in and quarter out. It really is about setting yourself up with a good strategy from the very get-go, knowing yourself as an investor. Some folks, they're more risk averse than others. I mean, I would consider myself to be willing to take on a lot more risk. Now, that's probably partly due to what we do for a living, but the fact remains that you need to know yourself as an investor. Everybody is a little bit different.
We've got a report with 5 stocks to help you build and protect your wealth. You can find it at fool.com/protect. So check that out. Ron, before we get to the stocks that you and Jason have, look, we're not in the business of predicting the next crash, but we are in the business of looking at the economy. Are there any indications that you see, other than the fact that we're in a bull market that's much longer than average, that make you think, yeah, if a recession comes just around the corner, I'm not going to be surprised?
Yeah, there are several warning signs, and again, they're hard to predict going forward, but you can look at where we are right now, and they're often in the news. One that has been in the news over the last 6 months is this inverted yield curve, where the 10-year Treasury note actually has an interest rate associated with it that is less than the 2-year Treasury note. That inversion of the yield curve typically has signaled recessions. A recession occurs about 22 months on average after this inversion happens, according to a study by Credit Suisse. So that's one thing to look at. Gross domestic product, GDP, has actually been slowing. Still fine, but slowing. And then you have things like earnings growth estimates from companies that have come down dramatically this year. Certainly, you see pockets of growth that are just fine, and the stock market's up 22% this year, and that's great. But you do see earning growth estimates declining. And in conjunction with that, business spending is down, and that's a big fuel to the engine of our economy. So some things to keep in mind.
Yeah, sort of in line with spending being down, and I'm sure you're probably talking more about consumer spending maybe. But if you look over on the corporate side, we talked about this last week on Market Foolery, it appears at least that share repurchases are starting to pull back, right? We were looking at this S&P data. The second quarter of this year, share repurchases were down 20% from the previous quarter, down 13.7% from the quarter a year ago. Now, there's some interesting fact set data out there that really shows over long stretches of time, companies are fantastically wrong at share repurchases. I mean, that is if you're looking at it from the perspective of buying on the dip, right? Buying your shares at depressed levels in order to maximize the value that you return to shareholders. Typically what happens is in the glory days, they're buying back shares hand over fist, and that's what we've seen. But when things start to tighten up a little bit, when we start to see a little bit of a slowdown there, they really pinch those purse strings and stop those repurchases. And so my point is, if we are going into this period of time where share repurchases start to trend down, and that's a sustained period of time, we could be looking at a period of time where maybe there is some underperformance there in the market writ large. And if that's the case, I mean, as stock pickers, we love those environments because we can find some of those shares that really look like attractive values.
Yeah, and I'll add in some thoughts on valuation just real quick. So right now we're at a 22 times PE ratio, price to earnings ratio, on the S&P 500. To me, that does not feel ridiculous. It doesn't feel incredibly frothy, but it is significantly higher than the median over long periods of time of around 15 times. 15 times is the median over time, 22 times now. So certainly you could look and think that valuations are somewhat stretched, But you do have to look at the interest rate environment at the same time and think interest rates are so low, they've been so low for some time, that maybe 22 is okay and not something that we really need to worry too much about. But it's something to keep on the radar.
I feel like that's a real wild card here, too. I mean, interest rates have been so low for so long, and I feel like in my 10 years here at the Fool, we've been just pounding the drum. Interest rates have to go up, dang it, and they just aren't. If anything, they're going the other way.
Below zero.
Yeah, and so I mean, at some point you feel like they do have to go back up, but man, they have really stayed low for a while. And the point there is that with interest rates as depressed as they are, when you're looking for that return, I mean, the stock market really is the best bang for your buck these days. I mean, at some point that worm turns. I just don't know when that is.
If you're lucky enough to have cash on the sidelines when a correction hits and you're able to either buy more of the stocks that you already own that you love or buy new stocks that were on your radar and now look even cheaper, that's really one way to really compound incredible returns over very long periods of time by buying low, obviously, and one day later, well into the future, selling high. So if you have the temperament, if you have the cash, putting money to work during difficult times is a wonderful thing to do.
And you're lucky enough to have cash, but just curious, do you have a personal philosophy for you in a level of cash that you like to maintain so that you don't have to worry about being lucky as much as you're just preparing yourself? I mean, is there a level?
For me there is. I'm never fully invested, which the literature would probably say is a mistake because I'm timing a little bit here, but I'm usually 5 to 10% somewhere in cash personally.
Yeah, I mean, I tend to keep it around the same, and I mean, a lot of people I know want to maximize return and figure out a way to get something on that cash, but to me, I've always viewed it as the liquidity really is your return. Having that capital at your availability whenever you want it, I mean, that's the return really.
All right, let's get to some stock ideas for people who are looking to put a little cash of their own to work. And Ron, I'll start with you.
I like waste management for this purpose. As I think most people know, provide trash removal, recycling, other services to residential and commercial customers. Dominant company in that business, limited threats of seeing demand outsourced or disrupted. Even in recessions, people need their trash removed for sure. It's largely recession-proof as a result. They have got really strong competitive advantages in that they own the largest network of landfills. It's very hard to duplicate that. They grow both organically and through acquisitions. They've increased their dividend for 16 consecutive years through good time and bad. The current yield is about 1.8% for those looking for some yield. I think this is a great one for good times or bad.
Jason, what about you?
Yeah, I mean, I love trash. Everybody makes it. We got to have it picked up. I'm going to go with one that maybe some people might question, but I like Alphabet. I mean, I think that when you look at where Alphabet is today as a company, I mean, this is a company, I mean, Google obviously is the property everybody knows about mostly, but I mean, they have 90% global search share. I mean, that's not by accident. I mean, it is the dominant search product out there, and search is something that to me serves as a utility for everyone in good times and in bad. But looking just beyond the search, I mean, they have 8 products now with more than 1 billion users each product. And Google Drive is just the latest to take it over that mark. So, I mean, whether you're talking about search or you're talking about maps or you're talking about YouTube, I mean, there are just so many ways that Google is a part of our life, that Alphabet is a part of our life every day. It's hard for me to imagine investors not doing very well owning those shares for a long time, even though I know it's a little bit of a political hot potato today.
2 more stocks, and then we'll get to some of your questions. Ron, what else you got?
How about Rollins, a provider of pest and termite control services, continuing on my theme of the most unsexy stocks I could find.
Protect your house, right?
Those who haven't heard of Rollins may know it better as Orkin or Western Pest Services. They acquire lots of these companies and roll them up. It's a very fragmented industry. Really steady performer, increased revenue and earnings every quarter over the past decade. They grow organically and through acquisitions for sure. Recession resistant because more than 80% of sales are recurring, and typically people are not going to let the pests come in even when times are tough. So I like this company. They've raised their dividend every year for the past 17, and you've got a 1.2% yield currently.
Jason, one more.
Yeah, I want to be very clear. There's data that went behind my decisions here, Chris. I mean, I look back at that stretch of the Great Recession to see how these 2 stocks performed, and they did really actually pretty well. Outperformed the market. They held their own. We got Alphabet as one, but the other one here, Travelers Insurance. And, you know, when you look at recessionary times, you want those companies where their products, their services aren't really optional. And in many cases, insurance just simply isn't optional. Everybody needs it. Now, I've had the good fortune of working for Travelers for a spell, so I can really testify to the quality of the business. I was always very impressed with the way they ran the show there, but they've got a lot of different insurance products. They continue to really record some just very impressive numbers, and the combined ratio is the metric that we look to with insurers, and that essentially is just telling us whether they're writing a profit or at a loss. Under 100 means they're underwriting an operating profit there. And if you look at the last 3 years for Travelers, the combined ratio is 97, 97.9, and 92%. They had one outlier year in 2011, I believe it was, where that combined ratio was 105%. I'm just going to say that was a hangover from the Great Recession, maybe. But all in all, a wonderful operator, a stock that's done tremendously well through the years. One that I'm a little bit surprised is not on more radars here in our foolish universe, but nevertheless, Travelers Insurance.
All right, that's 4 stocks for your watch list. If you'd like 5 more, go to fool.com/protect. We've got a report on 5 stocks to help build and protect your wealth. Let's get to the questions that are coming in from the folks who are watching. Anika asks, what do you mean by cash? Do you mean a money market, a savings account? I'm confused.
That's a great question. For me, cash is the money market that my broker offers for money that is uninvested. Now, you can search around and do better than that. You could put it into a short-term CD or various different instruments. For me, it's easier to just keep it there in the brokerage, so it's just right there when I need it to buy stocks.
Penny asks, Jason mentioned Alphabet. They have 2 shares, one with the ticker Goog and the other with the ticker Google. Which one should I buy?
A time ago, this may have been a bit of an easier choice when the price disparity was a little bit greater. Bottom line, I personally own shares of the GOOG. That's the Class C stock. The difference between that and the Class A GOOGL, the Class A stock gives you a vote. The Class C stock does not. Now, there used to be a price disparity there, and you could get those Goog shares for a little bit cheaper. Listen. The vote doesn't matter. You can have the vote, that's great. You're not gonna, I mean, it doesn't matter. So don't pay a premium for the vote is ultimately what I'm saying. Right now, they're essentially the same price. You could buy either or and you're gonna get the same economic interest in the company. But if you do see that price disparity start to expand a little bit, go with that Goog share. It's better bang for your buck.
But I don't want to send the signal that voting doesn't matter.
No, you're right,
You
it
should be
doesn't.
active shareholders and have a voice in the company that you're in.
And I couldn't agree more. My point was just more that Google is controlled by its founders and no amount of votes that you purchase is going to change that.
True.
Jonas says, greetings from Germany. Thanks for checking us out from Germany. Do you think we will see negative interest rates in the U.S. anytime soon? What would be possible side effects for stocks in case that happens? Great question.
It's a great question, and I'm not smart enough to answer it, to be honest with you. I see economists weighing in on both sides. Some that say it's inevitable. It almost seems like that definitely is where we're going, and others who say no, we'll avoid that. It would probably be good for stocks. I mean, although, on one hand, you can say if something like that is happening, something must be bad in the economy. However, probably all things being equal, stocks would love the lower the better, and negative is pretty much as low as you're going to get.
Missy asks, does it make sense to sell off the high volatility stocks, wait for the crash, and then buy them back? I did that before the last market crash, and it made out very well. Well, kudos to Missy for that strategy. It worked out for her. What do you think?
Yeah, I mean, we call that market timing. I mean, that's just it, plain and simple. Now, don't let the fact that you got it right once make you think that you can get it right all the time. And congratulations for getting it right. I think it's really difficult to pick that stuff on a sustainable basis. That's why we don't do it. There's just a long history of trying to do it. It's just very difficult to consistently do well. So for me, that's where I fall back to having a well-diversified portfolio from the very beginning, so that when you have exposure to some of those high volatility stocks, if you're well-diversified, you almost don't even care about that volatility because it's offset by stocks that aren't as volatile. And that really is the point of having a well-diversified portfolio in the first place.
Yeah, and I don't have the data in front of me, but the data shows that if you're out of the market for the top 5 or 10 days in a given year, the best days of those years, your returns are drastically different than the S&P 500 as a whole, and in fact could actually be negative. So you're taking the risk of kind of being out of the market on the best days.
Walter asks, are there better industries to be in during a recession? Great question. I just go back to something we've talked about before was you look at the Great Recession 2008, 2009, consumer spending in America dropped pretty much across the board with the exception of pets. People still, just like people still want their trash picked up, people are going to spend money on their pets, and pet stocks may be one more place to look.
I was very close to going with one of my best performing stocks to date is Zoetis, and that's the company that makes the vaccines and the medicines for our pets. And this is coming from the perspective of a guy with 3 dogs here. I mean, recession or not, I mean, our spending on our pets is not curbed. They're a part of our family to go with our other 2 kids. So does that mean I have 5 kids, Chris? I don't know. But either way, it's a lot of spending. And I agree with you. I think pet stocks are great. Again, I fall back to just those markets that you feel like are necessities. And insurance, things like waste management, those stand out.
Yeah, I would prefer people look into those types of industries, those type of stocks. Conventional wisdom says alcohol, tobacco, and cosmetics stay firm in a recession because people tend not to give those 3 things up. Up to your discretion whether you want to be in those companies or not.
And one more thing, I mean, you can really look towards those market leaders. I mean, companies that truly dominate their market. I mean, I think that's why Alphabet to me stood out, is because they're really just, I mean, there just is no company that holds a candle. Another company, Microsoft, same kind of position there in their market.
David asks, in your minds, what constitutes a crash in light of the market volatility? Down 10%, 20%, 30%? Think back to last December and the pullback there, which no one considers a crash. It's a fair point, and I think it goes to something you touched on earlier, Ron, with, some people use the word crash, they use the word recession interchangeably. They're different things. He may be right about the technicality of last December, but people do remember what happened last December.
For sure. Crashes, I don't know what the technical definition is, and that's why I tend to focus more on corrections, which are typically thought of as a decline of 10% or more. There's actually been 36 corrections of 10% or more since the beginning of 1950. That's one about every 1.9 years, so they do happen quite a bit. There have been 22 market corrections since 1974. Only 4 of them eventually ended up being a full-blown bear market. So just a short-term correction does not necessarily mean a long-term bear market.
And that bear market is 20% or more, is that right?
I'm going to say yes, because I'm not sure.
George asks, you mentioned Google. What about another tech giant, Amazon? Do you think it is another recession-ready stock?
I tend to think yes, and part of that is because it's a significantly different business than what we knew even 10 years ago. I mean, the Amazon Web Services side of the business now is one that it's one that so many businesses all around the world depend on. So again, it has that market dominating position. Amazon's done a very good job through the years of, while I wouldn't say they're pursuing this lowest price strategy, I think that what they have pursued is, we're going to give you a good price and really try to wow you with the convenience in shipping stuff to you in 1 and 2 days. And so consequently, more and more of our shopping behavior has migrated over to Amazon. So between the consumer, the domestic opportunity, the international opportunity that's growing, the AWS side of the business, I think there are a lot of reasons to think that it would perform well even during tougher economic times.
I agree with the AWS part of that thesis. I wonder if Amazon Prime is discretionary enough such that if your family's hurting, if you're going to take a year or 2 off and not renew and come back when things firm up a bit. I don't know the answer.
I don't, and I think we talked about that a lot when it came to Costco and their pricing power and being able to raise those membership fees. And I think if they do it in a thoughtful manner, then consumers probably feel like, okay, this is something I can handle. But yeah, if you felt like they were really out trying to make a quick buck and juice those membership fees on a consistent basis, even when times were tough, that probably would steer some people away, I think.
Keep the questions coming, and if you could, give us a thumbs up. It always helps if you like the video to actually click the like button. It helps other people find it. George's question makes me think back 10 years ago. We saw this sort of play out in the oil and gas industry where bigger really was better. It really was the giants of the industry that were able to sustain downturns because they had the cash on the balance sheet and they had other levers they can pull. You think about a company like Amazon, it's not always the most profitable, but you feel like Jeff Bezos can pull those profit levers when he wants to.
Excellent point, and that's one thing we really haven't discussed is the balance sheets of companies, except for when we talked about buybacks a bit. In a recession, the companies with stronger balance sheets, lots of cash, not too much debt, are the ones that can really weather the storm. And even if you're a bigger company, it's even better because you can take a margin hit. You could lower prices, or you can just take a hit to your business for a longer period of time than if you're a smaller company that is either marginally profitable or struggling, and maybe you're not going to be able to wait out the year or two.
Well, what Bezos say, right? Your margin is my opportunity, so there's something to it.
A couple of people asking, are there specific attributes we should be paying attention to in order to get a sense of a company's resilience? Throwing out things like high debt, low growth being indications there.
Yeah, so for companies that can weather the recession, you would want low debt, high cash. You would want companies that are non-discretionary, so that people really need to keep purchasing these things, and instead of saying, well, yeah, I can do without that. The companies that you can do without are in trouble in a recession, and if you add on a poor balance sheet to that, then that's a double whammy and could end up being pretty tough.
Yeah, you just made me think of Dave & Buster's, which is a business that has had some good years, and the stock has done well at various points, but it seems like in some ways a classic discretionary income stock that might be really challenged when the next recession hits.
For sure. Restaurants in general, any type of amusement, even movies, things like that in general would have a tougher time in a poor economy.
And you think about some of those businesses that maybe offer a lot of perceived value for a very minimal monthly cost. I mean, a lot of people talk about how they think Netflix is a wonderful recession time stock because it's such a modest monthly fee and you're getting really everything that you want out of it. And if you're pulling back on spending and going out to Dave & Buster's or whatever, you're probably staying home and watching a little bit more Netflix. So that could be another way to look at it.
And you mentioned Costco, which has a great perceived value for members. I think the discounters, whether it's Walmart or the dollar store or Target, are well positioned. Ross Dress for Less, TJ Maxx. Lots of folks like that would be well positioned in a down market.
Steve asks, looking at dividends, what is yield and how is it determined? Is it the same as interest earned or dividends earned?
Yield, the formula is the dollar amount of a company pays in a given year divided by the stock price. And just the way the math goes, if a stock gets crushed and goes down, by definition, the yield goes up. And so if you see a stock that has an artificially high yield, something above 5-6%, you just want to be a little bit careful because sometimes that can be just a great healthy yield where a company earns so much cash flow that it can return some of it to shareholders. But sometimes it might be a consequence of the stock getting smacked, and you just want to be understanding of why.
G asks, it seems like we are in a great generational transfer. What industries do you think millennials will push into success with their new wealth?
A generational transfer of the different types of services and products people are using, I'd imagine. I mean, it seems like these software as a service businesses are all the rage these days, and everybody's trying to figure out how to become a SaaS business or even a subscription business for that matter. So those are a couple of things that really come to mind, are businesses that are either running on that software as a service model or something that is offering up a steady subscription stream of revenue.
Yeah, I would say tech in general, things that offer convenience like an Uber. I'm not recommending that stock specifically.
Yeah.
Companies that are transformational in terms of DoorDash or how one can have things delivered to them. Amazon is a good, really prime example, no pun intended.
Taking big global trends, right? I mean, I feel like if I mentioned the war on cash one more time, Chris, you might slap me, but you and I coined that phrase together on
We're
a
fans
show,
of the
right?
war on cash.
I mean, you look at companies like PayPal and Square that really are helping us do more with our finances, right? Making it easier to move money around, keep track of things that are. So, I mean, I think those are great examples of businesses that are very forward-thinking, disrupting a market. I mean, let's face it, money's not going away. I mean, 20 years from now, you're still going to have to pay for stuff. It's just companies like Square and PayPal are helping us do it without having to fumble around with all this cash in our wallets.
Last question from Gerald, who asks, during a recession, are dividend aristocrats a safe haven for your money? I don't know if they're always a safe haven, but dividend aristocrats, which are companies that keep increasing that dividend for at least 25 years, you mentioned a couple, they're on a track record. They were increasing it through the last recession that we had.
They're typically among the most stable of companies. They're in the S&P 500 just by definition. As you said, 25 years increased dividends, so they're generating this cash flow in excess of what they need to operate their business, so they're consistently returning it to shareholders more and more each year. So by definition, these are stable companies. Most companies will still get hit in a market correction. They just might get hit less.
All right, Ron Gross, Jason Moser, guys, thanks for being here.
Thank you.
Thanks so much for watching. Check out the report of 5 stocks to build and protect your wealth. You can go to fool.com/protect to get that report. For everyone here at the Motley Fool, I'm Chris Hill. Thanks for watching. We'll see you next time.